Hey everyone, welcome back to Corporate Decoder. Today we're diving into CPI AEROSTRUCTURE's latest quarterly report. Spoiler alert, it's a bit of a bumpy ride, so buckle up. You know when you are flying and the captain turns on the seatbelt sign, consider this video your airplane, and those turbulence are what we will look at today. This report gives us a look under the hood and things aren't exactly smooth sailing. Revenue is down, they are in the negative and they had a debt issue, but hey, they also got a waiver. If you like getting straight to the point, make sure you're subscribed so you don't miss the next video. We also have a Discord community in the description below if you want to talk about business and finance. First, let's look at the financial health of the company. We'll start with the balance sheet, which shows what CPI AEROSTRUCTURES owns and owes. I'm looking at two dates here, March of 2025 and the end of 2024, so we can see how things have changed over the last 3 months. Accounts receivable, the money owed to the company, increased from $3.7 million, so $5.5 million. So they are owed more money now. That is good. They have asset for their leases that is decreasing, $2.08 to $2.30. It means they are getting closer to the end of the lease. The big picture is that their total assets went down from $67.9 million to $65.3 million. This means the company has less stuff overall. Also, their debts, called total liabilities, went down. Their shareholders' equity, what's left over after paying debts, also decreased from $25.9 million. Less money left for investors, brought from them dollars and none and all to investors. Now let's look at the income statement, which tells us about CPI Aero's performance Avenue. That's the total amount of money the company made from sales decreased from $19 million to 15 from 19 million to $15 for the 1 out of 5 customers or a big client just reduced the budget. Selling, general and administrative expenses, that's all the costs that are not directly related to manufacturing, went up from $2.7 million to $2.8 million. The bottom line, net income. They went from making $168,000 of losing $1.3 million. That is not a good trend. That is almost a $1.5 million difference. Also, since they lost money, the value of each share also is negative. The consolidated statements of shareholders' equity report is important for the owners of the company. They can see their stock amount, the paid in money and accumulated profits and losses. And it also shows where did the numbers come from. For the 3 months ended March, stock-based compensation, which can be seen as rewards to people working there, was about $320,000. Let's dive into the cash flow statement. This is what happens with the company's cash. First, looking at operating activities, which is the cash the company made from its core activities. We see that instead of gaining cash, they are using cash, over $2 million lost in cash. Ouch, this is worse than last year where they lost less than $1 million. For investing activities, they had a small negative spend, $59,000, used to buy some more equipment. Lastly, financing activities or cash spent by repaying debt and other financing instruments. And the company spent about $41,000, mostly in paying debt. So less debt, but a lot more cash spent. The result is that the company went from $5 in cash to only $1.8 million. A big drop seal. In the world of Warren Buffett, cash is king, and this king is being attacked. Let's go to some notes in the report, which is where they expand on a lot of what we saw above. Disaggregation of revenue, meaning where the revenue comes from. We can see that they make money from government subcontracts, prime government contracts, and commercial contracts. Another point, we see that in the last 3 months, they have had to make adjustments on their contracts. Those adjustments are big, a negative $3.1 million, meaning they lost that much money. And the report mentions problems with A10 program as reason for the loss. Here are contract assets and liabilities. We can see the amounts. It gets too complicated to explain in short terms. Sorry. It's about debt and line of credit. They had to get a waiver from the bank. They have a line of credit and they were supposed to stay within certain limits. They didn't, and the bank could have said, pay us back now. But the bank gave them a pass. This section is about risks and what they are committed to and how much it will cost them. They had a deal with the SEC, but they have to keep it. They did it so far and they intend to keep doing it. If not, a $400K payment is due. These are the things that happened after the quarter ended, but are still important. First, they extended their lease on their facility until 2031. Another fact, the lenders gave them a waiver, which means they don't have to follow the covenants. It is just for the last 3 months. But it's only for those 3 months. In the future months, they have to comply or they might be in trouble. In this section, we see that inflation and politics might affect business, which can be seen to every business. So what's the story here? CPI AEROSTRUCTURES had a tough quarter. Sales are down. They had to ask their bank for help and they lost money. A lot of this seems tied to problems on the A10 program. They need to get that program back on track and find ways to be profitable. If they can't, there are going to be further questions regarding their financial future. What do you think CPI AEROSTRUCTURES needs to do to turn things around? Are they in real trouble? Let us know in the comments. And if you found this breakdown useful, hit the like button and subscribe for more in-depth looks at corporate filings. Also, don't forget you've had our Discord community. Thanks for watching. See you next time.